What's up, everybody? The market's been a roller coaster, but now's the time to be greedy when others are fearful. Incredible companies are trading at a discount, strong fundamentals, massive potential. In this video, I'm breaking down 10 wide-moat stocks primed for explosive growth. These are companies with a durable competitive advantage and consistent profitability. So grab your notepad and get ready to take some notes. Let's dive in. Estee Lauder, a global beauty powerhouse behind MAC and Clinique. Known for quality and innovation, it's a multi-billion-dollar industry leader. Despite recent stock dips, it's a prime opportunity for investors. Remember, be greedy when others are fearful. Estee Lauder has staying power and a strong balance sheet. Now let's talk numbers, because that's what really matters, right? Estee Lauder is currently trading at a price-to-earnings ratio significantly lower than its historical average. This means that relative to its earnings, the stock is undervalued, and that's music to our ears. But it's not just about the numbers. Estee Lauder is constantly innovating and expanding its reach, particularly in the rapidly growing Asia-Pacific market. They're tapping into the digital space like a boss, with a strong online presence and a focus on e-commerce. And let's not forget about their incredible brand loyalty. Once you find an Estee Lauder product you love, you're hooked. So to sum it up, we've got a company with a rock-solid market position, a history of strong financial performance, and a commitment to staying ahead of the curve. And right now, it's trading at a discount. That's what we call a no-brainer, folks. Of course, I'm not a financial advisor, so don't take this as financial advice. But if you're looking for a long-term investment with massive potential, Estee Lauder is definitely worth a closer look. Alright, moving on to Huntington Ingalls Industries, or HII. The largest military shipbuilding company in the US, they build aircraft carriers, submarines, and destroyers. Specialized knowledge and advanced technology are key. Huntington Ingalls is the best in the business. Their reputation for quality and reliability is unmatched. With rising geopolitical tensions, demand is increasing. Now, I know what you're thinking. Defense is a pretty niche market, right? Well, yes and no. The US government is the biggest customer, that's for sure. But Huntington Ingalls is also expanding into international markets, providing shipbuilding and maintenance services to allied nations around the world. And it's not just about ships anymore. They're also involved in other areas of national security like unmanned systems, cybersecurity, and mission-critical solutions. They're diversifying their portfolio and positioning themselves for long-term growth, which is exactly what we like to see. But here's the best part. Huntington Ingalls is also a dividend aristocrat. That means they've increased their dividend payout for over 25 consecutive years. Talk about a company that's committed to returning value to its shareholders. So if you're looking for a stable, undervalued stock with a patriotic twist, Huntington Ingalls Industries is definitely worth considering. Alright, let's talk about a company that needs no introduction. Pfizer. You know them, you've probably heard of them, maybe you've even used their products. They're one of the largest pharmaceutical companies in the world, and for good reason. They've been around for over 170 years, and they're responsible for some of the most important medical breakthroughs in history. I mean, think about it, the first commercially available antibiotic, the polio vaccine, Viagra, all Pfizer. They've constantly got something going on in their labs, and they're always looking for the next big thing, and that's what I love about them. They're not afraid to invest in research and development, and it shows. Now you might be thinking, Pfizer? Isn't that stock kind of boring? And yeah, it's not exactly Tesla, but boring can be good, especially when it comes to investing. Pfizer is a well-established company with a proven track record of success. They're not going anywhere anytime soon, and their stock is a solid long-term investment. Plus, they pay a pretty sweet dividend, which is always a nice bonus. Why is Pfizer's stock undervalued? Increased competition and uncertainties. But Pfizer's investments in R&D and acquisitions position them for long-term growth. They have a diverse product portfolio and a strong pipeline of new drugs. Pfizer is a compelling opportunity for long-term growth. Let's dive into a fascinating company, International Flavors and Fragrances, or IFF. Ever wondered what makes your favorite drink refreshing or shampoo smell good? IFF is behind it. They create flavors, fragrances, and ingredients for everyday products, from food and drinks to perfumes and cleaning products. IFF shapes our sensory experiences. They influence our moods and decisions. IFF sells experiences, not just products. That's their competitive edge. So, why do I think IFF is a great buy right now? They have a diverse product portfolio and a global reach spanning over 150 countries. Diversified across industries, IFF offers stability and growth potential. Constantly innovating, they're expanding into new markets. Investing in R&D, they're exploring AI and biotechnology, focusing on natural and healthy ingredients. Despite their strengths, IFF's stock is trading at a discount. Short-term headwinds like rising costs are temporary. IFF has a proven track record of overcoming obstacles. This dip is a fantastic buying opportunity. IFF is a hidden gem poised for significant growth. Alright, let's talk about a brand that needs no introduction, Nike, synonymous with athletic performance, style, and innovation. Who doesn't recognize that iconic swoosh logo? A global powerhouse in sportswear for decades, dominating the market with cutting-edge products and powerful marketing. An aspirational brand for athletes and casual consumers alike. Nike's stock price is high, but there's still room for growth. Nike is a global brand with a loyal customer base and significant growth opportunities. Their digital prowess and commitment to innovation and sustainability set them apart. Nike is a solid long-term investment. Alright, moving on to our sixth stock on the list. We're talking about Campbell Soup Company, ticker symbol CPB. You know them, you love them. They've been around since 1869. And here's the kicker. CPB is looking seriously undervalued right now. We could be scooping up some shares at a discount. Now, when you think Campbell's, you probably think of their iconic red and white soup cans, and yeah, that's a huge part of their business. But they've actually diversified quite a bit. They own other popular brands like Pepperidge Farm, Goldfish, Snyder's of Hanover, and V8. That's right, Campbell's isn't just about soup anymore. They're a snack food powerhouse, and let's be real, everybody loves Goldfish crackers. I mean, who hasn't indulged in a handful or two of those cheesy little fishies? They're addictive, and this diversification is key. It means Campbell's isn't reliant on just one product or market. They're spread out, reducing their risk and giving them multiple avenues for growth. Plus, they're constantly innovating, coming out with new flavors and products to keep things interesting. So, if you're looking for a stable, undervalued company with a strong track record and a portfolio full of household names, Campbell Soup Company is definitely worth a closer look. Remember, we're looking for those long-term holds, and CPB could be a real pantry staple in your portfolio. Alright, let's raise a glass to our seventh stock pick, Brown-Forman Corporation, trading under the ticker symbol BF.B. And before you ask, yes, they're the guys behind Jack Daniels. But it's not just about whiskey with these guys. Brown-Forman is a global powerhouse in the wine and spirits industry. They own a diverse portfolio of premium brands including Jack Daniels, Finlandia Vodka, Woodford Reserve, and Herradura Tequila. Talk about a lineup. They're basically a one-stop shop for all your top-shelf needs. And here's what makes them interesting. The global demand for premium alcoholic beverages is on the rise. People are trading up for higher quality, and Brown-Forman is perfectly positioned to capitalize on this trend. Plus, they have a strong track record of successful acquisitions, expanding their reach and portfolio even further. But here's the thing. Despite their impressive brand portfolio and growth potential, BF.B is trading at a discount compared to its peers, and that's what we like to see. This could be a chance to grab shares of a high-quality company at a bargain price. Now I know what some of you might be thinking. Alcohol? Isn't that a risky industry? Well, not necessarily. See, Brown-Forman operates in the premium segment, and people who enjoy top-shelf spirits tend to be less affected by economic downturns. They're also a global company with sales in over 170 countries. This international diversification helps to mitigate risk and provides a buffer against any weakness in specific markets. Basically, they're not putting all their eggs in one basket. And let's not forget about the power of their brands. We're talking about iconic names like Jack Daniels, a brand that's recognized and enjoyed worldwide. This kind of brand recognition and loyalty is invaluable in the competitive world of alcoholic beverages. So, if you're looking for a company with a strong competitive advantage, a global footprint, and a portfolio of beloved brands, Brown-Forman is definitely worth considering. Remember, we're in it for the long haul, and BF.B has all the ingredients for a smooth and profitable ride. Cheers to that. Alright, let's move on to stock number 8, and this one's for all you healthcare enthusiasts out there. We're talking about Zimmer Biomet, trading under the ticker symbol ZBH. Now, Zimmer Biomet is a leader in the musculoskeletal healthcare space. What does that mean exactly? Well, they develop, manufacture, and market a wide range of products designed to help people with bone, joint, and soft tissue injuries. Think hip and knee replacements, dental implants, and even surgical robots. They're basically giving people the gift of mobility and a better quality of life. Now, the global population is aging, and that means the demand for musculoskeletal healthcare solutions is only going to increase. People are living longer, which unfortunately also means more wear and tear on their joints, and that's where Zimmer Biomet comes in. But here's the kicker. Despite their strong position in a growing market, ZBH's stock price has been lagging recently. This could be due to a variety of factors, including overall market sentiment and concerns about elective surgeries being postponed. But this dip could represent a buying opportunity for savvy investors. Now, I know what you're thinking. Healthcare is a complex industry and it can be hard to pick winners. But Zimmer Biomet has a few key advantages that make them stand out from the crowd. First off, they're a global leader with a massive distribution network. They're also investing heavily in research and development, constantly innovating and bringing new products to market. This commitment to staying ahead of the curve is crucial in the fast-paced world of healthcare technology. Remember, nobody wants to be stuck with outdated equipment. And let's not forget about the power of their brand. Zimmer Biomet is a trusted name in the industry. Known for its high-quality products and commitment to patient care, this kind of reputation is invaluable in healthcare where trust and reliability are paramount. So if you're looking for a company with a strong competitive moat, a solid track record of innovation and a bright future ahead, Zimmer Biomet is definitely worth a closer look. Remember, we're looking for those long-term winners, and ZBH could be just what the doctor ordered for your portfolio. Alright, moving on to number 9 on our list of Wide-Moat stocks, NXP Semiconductors. NXP is everywhere. Automotive, industrial, mobile. The world is becoming digital and reliant on tech. At the heart of all that tech are semiconductors. NXP is a major player growing in electric vehicles, autonomous driving, and 5G. Think of it like investing in picks and shovels during a gold rush. Now let's talk numbers. NXP currently trades at a price-to-earnings ratio that's below the industry average. And when I see a company with a solid track record, a bright future, and a price tag that seems too good to be true, I get really interested. Remember, we're looking for undervalued companies with strong moats, and NXP checks all the boxes. They've got a history of innovation, a strong management team, and a clear vision for the future. To me, that screams long-term value. And look, I'm not saying the stock price is going to skyrocket overnight. This is a long-term play, people. But if you're looking for a company that's well-positioned to benefit from some of the biggest trends in tech, NXP is definitely worth a closer look. Don't just take my word for it. Do your own research, look at their financials, and see what the analysts are saying. But I think you'll find that NXP Semiconductors is a compelling investment opportunity. Last but not least, we have MarketAxess Holdings, a company that's changing the way bonds are traded. Now I know what you're thinking. Bonds? That doesn't sound very exciting. But trust me, this is a big deal. See, the bond market is massive, even bigger than the stock market, but it's also incredibly outdated and inefficient. That's where MarketAxess comes in. They've created an electronic trading platform that connects buyers and sellers of bonds, making the entire process faster, cheaper, and more transparent. And let me tell you, this isn't some small-time operation. MarketAxess is the leading electronic trading platform for corporate bonds, and they're rapidly expanding into other areas like government bonds and emerging markets. They're literally disrupting a multi-trillion-dollar industry. This is like the early days of online stock trading, but for bonds. Remember what happened to companies like E-Trade and Ameritrade? They exploded in value as more and more people started trading online. I see the same potential for MarketAxess. Now let's talk about why MarketAxess is a wide-moat business. First off, they've got a first-mover advantage. They were the first to market with this technology, and they've built up a dominant market share. It's going to be very difficult for competitors to catch up. Second, they benefit from strong network effects. The more buyers and sellers that use their platform, the more valuable it becomes for everyone. It's a virtuous cycle that creates a huge barrier to entry. And finally, MarketAxess has a long runway for growth. The bond market is still largely offline, but that's changing rapidly. As more and more trading moves online, MarketAxess is perfectly positioned to capitalize on this trend. Now, MarketAxess isn't exactly cheap. It trades at a premium valuation compared to the overall market. But remember, you get what you pay for. This is a high-quality company with a long growth runway. I think it's worth paying up for. And there you have it, 10 wide-moat stocks that I believe are undervalued and poised for growth. Remember, these are just a starting point for your own research. Don't just take my word for it. Dig into the numbers, understand the businesses, and make sure they fit with your own investment strategy and risk tolerance. Investing is a marathon, not a sprint. It's about finding great companies with long-term potential and holding them for the long haul. And I truly believe that these 10 companies have what it takes to deliver solid returns for years to come. Now, if you found this video helpful, please give it a big thumbs up and subscribe to the channel for more investing insights and tips. And as always, thanks for watching.